Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. There's a financial secret that very few people ever talk about, yet it sits right in front of your face every single day, and this secret is for business owners and aspiring entrepreneurs. It's the fact that buying a vehicle in your personal name is one of the most expensive and limiting financial decisions that you could ever make. That may sound dramatic, but once you break down the numbers, the tax laws, the credit implications, and the long-term financial consequences, you will wonder why you ever allowed a car dealership to convince you to put a vehicle under your personal credit. In this video, I'm going to show you exactly how to buy a car in your business name, how to get approved even if your business is new, which lenders actually say yes, and why the tax advantages alone can save you thousands every year. And this isn't just a theory. These are the exact steps that business owners use to keep their personal credit clean, lower their debt to income ratio, and access bigger funding later. By the time you finish this video, you'll understand why wealthy people rarely put vehicles in their personal name and how you can use the same strategy starting today. So without further ado, let's get right into the video. Let's start with the biggest disadvantages to purchasing a vehicle under your personal credit, and that's going to be the effect it has on your debt to income ratio. So let's say that someone buys a personal vehicle with a $500 to $800 monthly payment. The payment will show up immediately on your personal credit report. And that means when they try to get another credit card, a line of credit, a mortgage, or even another car, lenders see that additional monthly obligation. That single car note now raises their debt to income ratio, which is one of the most important approval metrics in all of lending. Debt to income ratio is calculated by taking all of your monthly debts, like your student loans, credit cards, mortgages, personal loans, and your car note, and dividing that by your monthly income. Lenders want to see that number stay low, usually somewhere around 32%, and if it gets too high, even if you have good credit, you will still be denied. A car loan can easily push that number up by 10 or 15%, which can be the difference between being approved or being denied for funding that you actually need to grow your business or even purchase a home. So when you finance a car personally, you are limiting your own ability to access additional money later. Every dollar you owe personally is a dollar that lenders count against you. Your buying power drops, your credit profile appears heavier, and even if your score is high, lenders may offer you worse terms simply because your DTI is just too excessive. This is why business owners who understand the system keep their personal credit pristine. They use it only for the things that truly matter, like real estate or major low-interest financial opportunities. Meanwhile, everything else, your vehicles, equipment tools, even some travel gets funneled through the business and written off as a legitimate business expense. This will keep everything completely separate from your personal profile. One of the biggest differences between personal vehicle ownership and business vehicle ownership lies in how the U.S. tax system is structured. When your vehicle is owned or financed by your business, it's no longer just an expense. It becomes a tax-advantaged asset. The depreciation alone creates substantial deductions every single year. Most people believe that only large vehicles over 6,000 pounds qualify for major write-offs under Section 179, and while that accelerated deduction is certainly powerful, straight-line depreciation works on almost any vehicle. This means your business can legally reduce its taxable income every year simply by owning or financing a vehicle needed for business operations. Even if the vehicle is not used 100% for business purposes, a portion of the depreciation, the insurance, the maintenance, the fuel, and interest payments can still be written off proportionately. Imagine being able to buy a vehicle and use it for your company and then have the government essentially subsidize a portion of the cost. This is exactly what business owners do. Depreciation alone can save you thousands of dollars annually, and when you combine it with interest deductions, maintenance deductions, and legitimate business miles, the savings become significant. Now, every situation is unique, so it's important for you to speak with a tax professional and ask them about straight-line depreciation. Ask them about Section 179 and also ask them about bonus depreciation, but do not leave that money on the table. When used correctly, a business-owned vehicle can give you financial flexibility that employees never get to experience. Here is something that most people never learn until it's too late. Lenders judge your business long before they ever look at your application. They look at your business name, they look at your address, they also look at your phone number, they look at your website, and they look at your digital footprint. And if any of it looks suspicious, inconsistent, or unprofessional, they might decline you without hesitation. I did underwriting for a few banks, and if your business had words like properties and investments, which sounds good and it may feel professional on paper, lenders and banks immediately categorize it as high risk. They assume that you're in real estate investing or business models that rely on cash to produce income, which to them can mean high risk business models. They won't even open a checking account for you, let alone extend you credit. Banks assess risk categories based on business name alone, certain industries, keywords, and business types will trigger automatic denials. And the solution is to structure your business in a way that avoids those red flags entirely. I have an entire video that shows you how to structure your business. I'm going to link that video right here. However, a clean general business name will help you avoid the risk of flags, and a commercial or virtual address tells lenders that you are serious and not operating from your bedroom. Consistent online listings confirm your existence, while your EIN and your DUNS number tie everything together to form your business identity. When your business looks, feels, and operates like a legitimate company, lenders treat it like one. And once your foundation is correct, you open the door to almost any type of financing, including auto loans. Once your structure is in place, the next step is to make your business lendable. Businesses do not get approved because the owners want money. They get approved because lenders trust that business's ability to repay the loan. That trust comes from two places: your personal credit and your business credit. Personal credit will still matter even if your ultimate goal is to achieve EIN-only approvals. A strong personal credit report shows responsibility, consistency, and financial awareness. Lenders use it to evaluate your discipline. Even if the loan doesn't require a personal guarantee, they still may perform a soft pull or check your background. So a good personal credit report should have no late payments, no collections, no charge-offs, and a solid average age of account history. Also, responsible utilization. You don't need to have an 800 score to qualify for business auto loans, but a clean, healthy profile does make everything easier. Business credit will become your business's financial resume, and it proves that the business can handle debt independently. To build business credit, your company needs vendor accounts that report to the major business bureaus. These can be starter vendors, they can be gas cards, they can be supply accounts like net 30s and equipment financing, but the key is consistency, diversity, and the presence of at least one large high limit account that shows comparable credit. Comparable credit is one of the most important concepts in business lending. It means that your business has already been trusted with credit similar to the amount that you're applying for. So if your largest account is a $50 net 30 invoice, lenders doubt that you can responsibly manage a $15,000 auto loan. But if your business already has a history of larger trade accounts or equipment financing, lenders feel far more confident. This is why businesses with 7 to 10 reporting accounts, including at least one 4-figure account, see dramatically better approval odds. Once again, I have another video on building business credit. It takes you through the exact steps that you need to establish business credit scores within 30 days. And if you're looking for a larger line to report to your business credit report, I have another video on Credit Strong, and it's about a trade line that will actually report a higher line of credit. I'll link those two videos here as well. Now that you understand the foundation and how the credit requirements work, we can talk about the lenders that are actually approving business auto loans today, and we're going to be starting with Ally Bank. Ally is one of the largest auto financing providers in the country, and they have a dedicated commercial vehicle department with 2 different pathways. One option requires the personal guarantee. The second option is business name only financing, which means no personal guarantee and no credit check. Since most dealerships partner with Ally, you won't apply directly through the bank. You go through a dealership that will use Ally as their financing partner. And this is why understanding the process ahead of time really does matter. You have to know what to ask for and how to present your documents so it's obvious that you're prepared. First, you need your business entity formation documents. That means your articles of incorporation or your certificate of formation. This proves that your company is legitimate and it's active. Next, you need your EIN letter from the IRS, also known as the CP-575. If your business has moved or changed addresses since you first received your EIN, the address on the letter might be outdated, but Ally will need the address on your financing application to match what the IRS has on file. If the addresses don't match, it creates uncertainty and delays. The good news is that updating your EIN letter is simple. You can call the IRS, ask them to update the address, and once it's corrected, request they fax over that updated copy of your letter. If you tell them you need it for financing, they will usually send it very quickly. You also want to bring at least 3 months of business bank statements. These statements need to show actual revenue coming in. The stronger and more consistent your deposits look, the easier the approval process becomes. Remember, this is business financing, so personal bank statements won't matter here. You should also be ready to provide your business address, your gross annual revenue, and basic ownership information. Once you have all of this together, you are ready to walk into any dealership that uses Ally's business financing program. Since you can apply directly through Ally, the next step is finding a dealership that participates in their business financing program. Fortunately, everything is laid out on Ally's website. You simply go to the Ally site, navigate to auto selection, click on business financing, and use their dealership locator tool. Once there, you select the type of vehicle brand that you want, you enter your zip code, and the system will show you every dealership in your area that works with Ally for business financing. Once you arrive at the dealership, you need to specifically request Ally's business name only financing program. If you simply tell the salesperson that you want business financing, they may default to a personal guarantee because that's the only process they may understand. Make it clear though, you want business name only options with no personal guarantee if your business qualifies. Before we talk more about the no PG path, you need to understand how the personal guarantee option works. This option is still business financing, but it requires a credit check on the business owner. Many people assume that once you provide a personal guarantee, the auto loan will automatically show up on your personal credit report. With Ally, that is not the case. The only thing that hits your personal credit is the inquiry. However, if you default on the loan, then it can report to your personal credit. The actual auto loan or lease report only reports to the business credit bureaus, but the payments, the balance, the debt, all of that stays in your business name. However, you do need to keep in mind, if you default on the loan, then it can be reported to your personal credit. The personal guarantee simply acts as a backup for the lender. If the business stops paying, the owner does become responsible, but as long as that business pays as agreed, the loan never appears on your personal credit report. The personal guarantee is often required in certain situations. For example, if your business is less than a year old, Ally may ask for a guarantee because new companies are considered higher risk. If your business has low revenue, that can also trigger a guarantee requirement. If you don't have a Dun & Bradstreet file, or if your business has fewer than 10 accounts reporting to your business credit report, then Ally may request a guarantee as well. The good news is, even if you have to start with the personal guarantee route, this still benefits you long term. The loan builds business credit and it stays off your personal report, and it opens the door to a no PG approval later. Now let's talk about the real goal: business name only financing with no personal guarantee. To qualify, Ally is going to heavily evaluate your business credit reports, especially your Dun & Bradstreet file. The D&B Paydex score is usually the first thing that they look at, and you want to have a Paydex score of at least 80 or higher. That shows that your business pays its invoices on time or early. But the score alone is not enough. Ally wants depth, and they also want history. That means trade lines, payment cycles, and proof that your business has consistently handled credit over time. I also recommend having at least one high limit trade line. The ideal profile will include at least 10 trade lines reporting and at least 12 months of payment history, an 80 Paydex score, and consistent business revenue, as well as bank statements that show real deposits. However, you can still be approved even if you don't check every single box. Ally looks at the entire picture, not just one number. If your business is under a year old or you have fewer trade lines than recommended, there are still ways that you can make this deal happen. Ally may still approve you if you provide compensating factors. Now, one of the strongest compensating factors is offering a down payment. Putting 10 or 20% down will reduce the risk for lenders and can counterbalance thin credit history. Strong business revenue is another major factor. If your bank statements show consistent deposits, Ally may overlook the fact that your D&B report is still developing. Time operating can also help. Even if your business is under a year old, strong enough revenue with a down payment can sometimes make it possible to still do the no PG option. However, you still need to be realistic. If you're 8 months into business, you only have a few trade lines, you have minimal revenue and no down payment, it becomes extremely difficult to qualify for a high value business vehicle with no personal guarantee. Lenders want to see that the business has the ability to handle the debt, and if you go in understanding your company's strengths and weaknesses, then you'll know which approach makes the most sense for you. Sometimes the business simply does not have enough history for a no PG approval, and in those cases, Ally will fall back on the personal guarantee option. If that happens, it's not the end of the world. You still get the loan in your business name, you still build business credit, and it still protects your personal credit from the actual debt. And once you build some payment history, you can attempt a no PG approval on your next vehicle. Think of the first vehicle as your gateway into Ally's business financing system, and once they see consistent payments, steady revenue, and responsible management, their risk goes down and your future approvals become way easier. Most business owners who start this process end up needing more than one vehicle. The long-term strategy is where things get interesting. Once you get your first approval with Ally and make on-time payments, the next vehicle becomes significantly easier to obtain. The dealership already sees your history, Ally sees your previous performance, and that alone can qualify you for larger approvals, even no PG approvals later. Once you have multiple vehicles paid on time, you also open the door to commercial lines of credit specifically designed for buying vehicles. Ally and other lenders offer fleet financing programs, commercial credit lines, and expanded limits for businesses with proven track records. This is how companies go from one business vehicle to 5 to 10 or even an entire fleet. It starts with one approval, one set of payments, and a well-built business credit profile. Getting business vehicle financing with no personal guarantee is absolutely possible, but it does require understanding how the system works. You need the right documents, a clean DMV profile, strong bank statements, and ideally at least 1 year of business credit history. Even if you don't meet those requirements yet, you can still leverage the personal guarantee path and use it as a stepping stone to build towards no PG approvals in the future. The long-term benefits go far beyond getting a car. You're protecting your personal credit and you're building your business credit profile. You're also creating a separation between your personal life and your company, and you're positioning your business for larger financing opportunities down the road. That's how real business owners scale responsibly, and now you know how it works, so you can do the exact same thing. Once again, thank you guys so much for watching this video, and you have a wonderful day.